With inflation persisting, markets took a nosedive following core inflation figure announcements yesterday, but they've since recovered their losses. Today, we're discussing the markets, where inflation is likely to go, the rising US dollar, and what this news-packed week is likely to mean for all of us following the DeFi space. The US Bureau of Labor and Statistics presented their findings, which included core CPI at 6.6% year-on-year. This is the highest core CPI has been since back in 1982. Now, the significance of long-term view can be sometimes overlooked in DeFi considering just how young the space really is. So to really drill it in, we're talking about the worst consumer price index figures in over 4 decades. Inflation data came under the microscope this year, given its influence on the Fed's interest rate decisions. We're certainly far from the 2% inflation target set out by the Fed, so they're quite likely to increase the interest rates again next month. In fact, there's reportedly a 96% probability we'll see a 75 basis point hike in November. Considering the likelihood has gone up 2% already while filming, it may well even be higher by the time you watch this. Now, for context, monetary policy decisions taken by the Fed are important as they affect how everyone borrows and spends their money. In short, when interest rates are higher, it costs more to take out a loan. We generally borrow less and save more, meaning demand falls, and most importantly, the economy shrinks. And believe it or not, that's actually what the Fed wants. So in the Fed's words, by getting inflation or the core CPI under control, the idea is to prevent far greater economic pain. Runaway inflation can lead to a nightmare scenario where your money loses value shockingly fast, as we've seen in countries like Argentina, so that's undoubtedly what the Fed's trying to avoid. But what is core CPI? So core consumer prices, as they're sometimes called, don't include energy or food prices because of the volatility. So this figure generally provides a better measure of long-term trends. Before we carry on, let's hear a quick word from our sponsors who make these videos possible. Galaxy is the leading Web3 credential data network in the world. This collaborative credential infrastructure enables brands and developers to engage communities and build robust products in Web3. With Galaxy, users can explore Web3 in learn-to-earn campaigns with over 700 partners. On the other hand, builders have the opportunity to create growth campaigns on a seamless plug-and-play dashboard. Galaxy is constantly innovating, introducing Galaxy Passport, the one-click solution to verifying Web3 identities. Mint yours today. Speaking of trends, the S&P put in a new low after major indexes fell for the 6th straight day. After the Fed basically doubled down on their plans to aggressively hike interest rates, both the S&P and the Nasdaq printed 2-year lows. In a seesaw-like action this week, both stock markets and crypto prices dipped and recovered following the announcement. At first, the Fed's CPI figures had a negative impact on the Nasdaq, which dropped 3% before the losses were recovered. Now, the tech-heavy Nasdaq exchange is up 3%. But what about the macro outlook? What do the charts tell us if we zoom out? With prolonged inflation causing central banks to aggressively hike interest rates, stocks have suffered immensely. Last year, we saw the S&P surge an eye-popping 27%, but the economic downturn and the interest rates have caused it to plummet about 25% this year. Now, the Nasdaq suffered even more and is actually down 34% on the year. According to Morgan Stanley, the pain isn't over and the S&P could fall another 10 to 20%. In stablecoin news, USDT has completely eliminated commercial paper from their reserves. The company's main reserve assets are now US Treasury bills instead. Tether's USDT and its reserves have been questioned frequently over the years, most notably by New York's Attorney General. So Tether's move was welcomed by the community as it seemed to ease any tensions concerning the stablecoin's future. What about the impact on the crypto market? And how will a stronger economy actually impact the crypto market? That's the real question here. In all likelihood, we may see a bearish move given the high CPI figures and the strong dollar. If institutional investors decide to take their capital out of Forex, out of stocks, out of crypto, and in favor of less volatile assets like bonds and gold, we could certainly continue on the same trajectory we're on today, at least until inflation's under control. That's it for today's quick take. We'll see you again next week.